I want to start with Mark, or Matt, I'm sorry, with Matt. Um, the elephant in the room is the national debt and deficit and demographics, ballooning interest payments the federal government will have to pay. The federal debt, I believe, hit 36 trillion on Friday. Is that right?
On Friday, wow, that's very specific. Something like, let's just round, or something like that.
And we have to finance approximately 10 billion in T-bills in the next year. And we added $1 trillion to our debt in the last 4 months. So that's the elephant in the room. Matt, what's your take on that? Where's this train headed?
So I guess I'd first say we share a lot of the concerns that Lauren highlighted. Right? The amount of debt that we have in the United States, the growing level of deficits, the policies, whether it's going to be this incoming administration or the other administration for candidate Harris. Both of those policies were going to lead to an increasing level of deficits, which just compounds the issues that are already present at the end of 2024. So we would agree with all of that. This is something, though, I guess where maybe I would disagree is in our ability or confidence to say when this will all come to a head. People have been concerned in our industry. We're investors, right? In our industry have been concerned about the level of debt and interest payments and deficits for 3 decades at least. And we really haven't seen anything meaningful show up in our markets or in the economy because of that directly. So we, again, share the concerns. We've written a white paper. We're more than happy to send it out to any of you who want to get into the weeds on any of this. But at some point, unless something changes and the debt levels come down, the deficit comes down, this will come to a head. And we think it shows up first in the bond market. You'll see a rising level of interest rates. And then, and I do think then, the issue becomes resolved. Congress, in particular, would look at the challenges and figure out a way to bring down the level of debt and solve the deficit problem. But unfortunately, it's going to have to come to a head, to a crisis or a mini crisis before Congress deals with it. We can talk about how I think it would be resolved, but we would share that concern. But I don't know whether or not it comes to a head in 2025 or in 2055. And I don't think anybody does.
So that was my big question is timing. So you mentioned the bond market. What are some other things that you think would be leading indicators where you'd say, okay, it could be hitting the fan here pretty soon?
Look, the financial markets are the best leading indicator of challenges in our economy. It shows up there first. They price in advance, whether it's 6 months, a year, 18 months. They look at it and they price things into the market. So I think that's by far and away the first place that you will see it, and that would cause Congress to address that issue. I'll give you a little, not even an anecdote, evidence from just about a year ago. So between June and October, I think it was, or maybe August and October. Yeah, the 3 months or at the late end of summer into the fall of 2023, you'll recall that the House of Representatives couldn't figure out who their leadership was. And at that point in time, the 10-year Treasury yield went from 4% to 5%. That's a 1% move in 3 months. Bond markets don't move that fast. That's a huge move in a short period of time. And it correlated directly with that discussion around who's the leadership in the House. And as soon as that was resolved, interest rates peaked at 5%, came right back down. The stock market fell 10% from the beginning till the end. And so I think that it's not a far cry to assume that if the issues continue, at some point it'll show up again in the bond market first, but then Congress will have to huddle up and resolve the issues either by raising taxes, cutting costs, or both of them in all likelihood in order to calm the market first and start to resolve the issue. This happened in the 90s, in the early to mid 1990s, where the bond vigilantes, which you might recall, forced the issue. And then in 2022 in the UK, when there was budget issues there, the bond market told government leaders to address the issue as well.
So some people believe that our status as the world's reserve currency gives us protection from that. I worry we have BRICS, GDP now exceeds ours, if cumulatively those 9 countries, their GDP exceeds ours, could that be a threat to that? Does crypto possibly present a threat to our status as reserve currency? And do you believe that it is a protection at all?
I think it is to a certain degree. We've been tremendous, extraordinary privilege being the world's reserve currency, but we shouldn't take it lightly. I don't think, as we think about the other places, the other countries that investors or lenders could put their money, nothing is like the United States. For all of our problems, for all of our issues, nothing is like U.S. Treasury bonds and the U.S. dollar. You can look at other major economies. They fall off a cliff in terms of the depth of the market, the safety, the lack of volatility of the United States market, again, with all of our issues. So if a lender, foreign investor, whomever, were to put money and park it somewhere they just want to collect some income and know that they're going to get paid back, where else could they go? Japan, it's a fairly stable economy, but they've got big challenges. They've got deflation or low levels of inflation. Europe has their own challenges. So I think you have to say, yeah, in the United States, we've got issues. We've got a lot of debt and a lot of deficit, and they're going the wrong direction. But where else are countries going to put money? And you start to get a smaller and smaller area. So we have to take that responsibility really seriously and address the issue, but I don't think we're going to lose meaningful amount of share 5, 10, 15 years from now unless something meaningfully changes on the other investable opportunities.
So you mentioned the bond market. So the Treasury sales, I envision that could be a place to watch. If people are hesitant to buy our T-bills because either they think there's a greater risk or because they say, I'm just going to hold off because the yield's going to have to go up. Is that something you would point to and keep a close eye? And the government has to start buying their own treasuries? That's a bad thing?
I certainly do think it would show up in rising interest rates. So, for example, just to oversimplify, if all of a sudden, whether it's foreign buyers of our debt or U.S. consumers, that's at the moment, a big share of who owns federal debt. If they all of a sudden say, because the 10-year Treasury today is about 4.4%, well, United States, you all are now a much riskier investment. If I'm going to park my money with you for 10 years, I don't think 4.4% justifies the risk that I'm taking on given the direction of travel of your deficit and debt levels. I now need 5.5% or 6 or 7. So the auctions that go off on a fairly regular basis would all of a sudden start to show rates are starting to move higher. There's less demand. You would start to see it in the secondary market as well. We've had a big move from the first rate cut, which was back in September, when the 10-year Treasury was 3.6% or so. We're now at 4.4. We're going in the wrong direction. I think a large part of that is because the market started to assume that President Trump, with his policies, was going to win. And with that, with those policies, greater debt, greater deficit, all of the issues that we're talking about and that we're concerned with, that was the secondary market pricing in greater risk. And so I think you would see it in rates. The other area that I think we need to watch is just the rating agencies. Do they, at some point, downgrade the United States again to a lower level than where they are, reflecting in a rating, not in rates, but in a rating, these issues that we're concerned about?
So of those things, what's going to trigger your call to Adam? All right, Adam, you need to change everybody's portfolios to go into protective mode.
So I think, look, as we think about how we should be managing asset allocation, again, at the end of the day, we're managing money for individuals, for families, for endowments, foundations, and up and down the asset class board. We are recommending that for those clients that would be severely impacted by inflation or by the degradation of debt level, prices declining on debt levels, to incorporate some amount of inflation-protected securities. Could be TIPS, could be the municipal equivalent. So we want to protect ourselves, or at least mitigate the impact on their portfolio, the real purchasing power of their portfolio from inflation by incorporating that. We want to ensure that they have still some stocks. Because to be clear, we don't think when this issue comes to a head that it will drag on for years. We think when it comes to a head, Congress all of a sudden coalesces around a solution, and they work towards that, and the market either does or doesn't believe them. If they don't believe them, then they'll coalesce around a different solution, but it will get resolved. And it likely results in higher taxes, cost cuts, and so forth, but it doesn't last for years, in our opinion. I understand both sides of it, but I believe Congress would address the issue and we would move on. So owning stocks, I think retaining exposure to stocks through this period of time will be helpful. Yes, there may be some volatility, but if we're right that the issue will get resolved, might get resolved and be painful from a personal balance sheet basis because we pay more taxes and we get less benefits. But still, the markets can through some volatility, recover. And trying to time these issues is really hard. And in the lead up to that, during inflationary periods, modestly inflationary periods, stocks can do well. You all know, you're business owners. You can charge higher rates if you've got pricing power. Your top line grows. And if you can manage your costs, maybe even your bottom line, you get margin expansion. So owning stocks, owning potentially some bonds with some inflation protection in there, real assets as well, should be protective in an inflationary environment. But we're not smart enough to know, first of all, when it's going to occur and what the ultimate resolution will be, and which asset classes will work the best during that environment, so we advocate for remaining diversified through that period of time.
So I've heard one economist say that clearly higher taxes, if as you say, Congress comes through and finally, I've got a slide somewhere about Winston Churchill saying that you can always count on the Americans to do the right thing, but only after they've exhausted all other options. So it's going to include cutting taxes and raising taxes and cutting expenses. What should we anticipate as far as a top-line tax? Some economists say that when you raise taxes past a certain point, it crowds out private investment, and about 19% of GDP is kind of the most you can squeeze out of that turnip. What's your take on that?
Yeah, so that's a hard one, and I haven't, personally, I'm not a political scientist, so I haven't done the math on how much taxes would ultimately be increased. I think it depends on when does this come to a head? Is it next year or is it in 25 years? That's going to drive a big difference. But the solution does come down to those two elements. We could also, in part, be more accepting of higher inflation. So Lauren talked about the Federal Reserve targeting a 2% level of inflation. Maybe in 5 years they target a 2.5% level of inflation. So we can inflate to a certain degree our way out of it. And then it comes down to productivity growth. So if we can get increased productivity growth, if you get all of those elements, then in 30 years, instead of debt to GDP being 170%, it's only 120%. If you just get some modest increases on improvements on those issues, but I don't know ultimately that's where the rubber meets the road. That's where the sausage is made. I'll leave that to the folks on Capitol Hill.
There's a lot of sausage up there. So, Jim, you understand the economics of individual businesses inside and out, and you've heard all this, and given this as a potential threat. How are you advising companies that you work with?
Well, look, I want to be careful saying this because I don't really mean it as a joke, nor in offense to anything Matt said. But I think that to assume that this all gets fixed because Congress suddenly gets functional is that may be the craziest assumption we've heard all morning, in all due respect. And I think you probably agree with that. That's a big leap to say Congress will figure this out. I think for business owners, now here's the deal. I can make a prediction too. I'll be happy to come back in 4 years and we'll see how this goes. I predict that EO will be out of business in 2030 because you will have all sold to private equity, and you're all gone. You're all making money. You've converted your businesses into cash, and there's no more EO members out there. Obviously, I'm joking, but the principle is fundamentals are really, really important in the face of this level of uncertainty. Fundamentals mean yeah, if you're going to ride the inflation wave that is probably coming, make sure your revenue is growing faster than your expenses. And that sounds so that's such a cliche, so obvious to say. I'm telling you, I see businesses frequently that they have let those two factors get out of control. A business owner says, "Well, I don't want to lose any customers, so I'm not going to raise my prices." Meanwhile, their expenses are growing, and that math doesn't work. It doesn't work. And when you are ready to sell, if you ever do want to liquidate and convert into cash and be ready to be a buyer in this, you want to be a buyer when this downturn comes, not a seller, right? And the way to do that is to sell prior to the downturn. Well, if you want to do that, the fundamentals matter, and that is revenue resiliency and growing profit margins. And growing profit margins require that revenue growth has to be faster than expense growth. And I feel almost embarrassed to say something so obvious, but I say it because I see evidence that business owners don't do that. So I think that in the face of all this uncertainty, flee to fundamentals.
So, as business owners, our appetite for debt and the importance of fixed rates, how are you advising folks on that?
Well, look, I think that when you're taking on debt, it's all about your coverage ratio, right? How much cash flow do you have to support your debt? I would always advise a business owner to be more conservative than their bank advises them to be, and that sounds almost, like an oxymoron because banks are by definition conservative. But I sold a lot more businesses in the past 5 years. I've sold a lot more businesses that have less debt than more debt, and so just anecdotally, that's evidence to me that if you can demonstrate organic growth, meaning you've got to think of your business as a preferred stock. You can grow, and you can pay a dividend at the same time. If you've got that kind of business without a lot of debt, you're going to sell for a very nice multiple. And I think that kind of multiple, that's a less risky exit strategy than trying to take on debt and grow through use of debt.
So, Adam, you focus on wealth and asset management, and so what are your thoughts on the steps that we should be keeping our eyes open? What should we be looking for, and how are you counseling your clients?
There's a lot there, and we've talked a lot about a lot of things, and Matt alluded to, we agree with a lot of what was said in here. I think we're maybe a little less static on the timing. One of the biggest takeaways, though, I would remind folks, and this may not be as intuitive, is if this is all to come play out, or if it's not, when you create liquidity with your business and really need the help of a professional, you want to make sure you're working with a research firm. And people are like, well, aren't all wealth managers research firms? You're probably surprised that that's not the case. AB's largest clients are UBS, Merrill Lynch, Morgan Stanley, the list goes on. They outsource the money management to us, and they buy our research. So when you think about this stuff, it's really complex. There's so many correlations and everything's moving around. Just make sure you're working with a team that can be thinking ahead, like you saw from Lauren today and you've heard from Matt. When crisis and disruption comes, we alluded to this before, Lauren did, there's opportunities. And it creates very exciting times for investors if you're ready. We haven't talked very much about floating interest rate investments. We work with a lot of business owners who sell their company. They were in control. That was their equity exposure. And then they think of the stock market maybe as legalized gambling because they're putting it into other equity that they have no control over. Well, so many of our business owners are thinking, well, how can I have a great, stable investment portfolio that's going to earn me equity-like returns without having equities in my portfolio? That's not where we start conversations, but if that's your emotional thesis, there's so many great opportunities when you are talking about higher inflationary environments, problems in the bond markets, and looking at floating interest rate investments in private companies, in private real estate, in aviation, like real estate in the sky. I mean, there's so many different things that you have to be considering to make sure it aligns with actually what your goals are and what your risk tolerance is.
So, you know, nobody agrees on exactly when the timing of everything, but just almost universally, people agree that our rising debt is going to cause inflation. So, how are you counseling people to what investments are you recommending to hedge yourself against that inflation?
So it depends, again, what's causing the problem, right? And Matt alluded to this, but in a normal inflationary environment like we've just been through, you know, there's very obvious things to investors like commodities-based stocks, inflation-protected securities on the municipal side, on the treasury side. Certain types of equities are very protective. So there's the obvious side. If bonds suddenly and you know, inflation protected bonds start to be, you know, or the bond treasury side starts to be the problem, you may need to be looking into the private markets. And that's where there's a ton of opportunity and dislocation today, and we believe that continues, right? Banks are under more stress because of capital requirements and regulation. We'll see if that comes down. But being a non-bank investor, a non-bank lender, is a ton of opportunity today. And so if you're making loans to high quality middle market businesses, you know, certain sectors of the real estate market, medical's really strong, life sciences, industrial distribution, you may have a comeback in offices in certain parts of the Sun Belt, things like that. You can beat inflation because those are floating interest rates. And if inflation's going up, interest rates are going up. And so there's a lot of, but it depends is the obvious answer of where that inflation's coming from.
So I used to think that residential real estate would be a great hedge against inflation. And then when it hit the fan with COVID, what do? They put a moratorium on evictions and then blew that out of the water. So do you see that ever happening? Is residential real estate still a decent hedge?
Absolutely, especially in markets like ours. And you saw the green states where migratory patterns are happening. I mean, there's no question that it's still a very solid asset class. COVID was a, you know, once in a generational, God bless, we don't see it again anytime in the near future, but that moratorium was not something that economists can plan or investors could really plan for. So we absolutely continue to see residential real estate as a very good and strong place to be putting capital, especially in Nashville.
All right, folks, we got a lot of brain power up here. Questions from the audience? Marla's getting a mic. Colton, you looking for a mic?
No, I was looking to see who's going to ask the question. My question is, who's going to ask the next question?
This one's for Jim. I think everybody can hear me. Of all the businesses that you've been involved with, you're buying and selling, you've seen the demographic challenges. What are some of your favorite industries that will thrive during the disruption in the next demographic shift?
I got to tell you, I'm less industry focused than I am business model focused. And if I had a whiteboard, we could graph kind of how I see multiples moving, and they move in accordance with the strength of the business model, and the industry is just sort of an interesting backdrop. So I don't approach my work as this is a X industry that gets this kind of exit strategy. It's really more the strength of the business model, and as I talked earlier about the strength of the fundamentals, the revenue growth rate relative to the expense growth rate, which implies a margin growth rate, the diversity of the customer base, the diversity of the supply chain if it's a manufacturing related company. Those are the fundamentals that drive the needle, not so much, oh, let's go to this industry and we'll be safe here. Because I've seen really crappy businesses in really good industries, and I've seen really good businesses in crappy industries. And it's all about the strength of the business owner and his or her judgment and how they create a business model and drive that business model.
Same question to you guys, though. If it's more micro, what's the more macro thought? Do you have one?
In terms of which industries are poised to perform well?
Because you're going to look at a diversified investment into an industry, right?
We are, and so I would echo the points that were just made, and I would say even within, let's just take technology, right? You've got great businesses that are performing well, top of the tier, and you've got other industry, even get down to semiconductors, right? A subsector of technology. You've got great performing businesses like NVIDIA, and you've got others where they're really, really challenged. So our job, we're active managers, right? We can invest passively into an index for clients, but the vast majority of our clients rely upon us for our research to determine within each sector and each asset class, which businesses do we want to own and which ones do we want to run away from. So it's hard to say which sectors. You can look at the list that Lauren put up in terms of growth rates for any individual sector. And that's a good backdrop, but ultimately you can make a lot of money investing in the equity of a business that's in a poor sector if all of a sudden their valuation is discounted, if they're right-sizing the ship, if they've got a new management team, a new strategy. So that's how we look at it.
I do have one, David.
I don't like using the mic. You can hear me, right?
Yeah.
Okay,
Yeah.
cool. So thanks to EL, I get to talk and work with folks up and down the East Coast, right? So then in the East Coast cities, you got 2,000 business owners. And as I've kind of traveled and talked to folks, there's a lot of folks using this phrase, the silent pandemic. And in Atlanta, Nerve, like 2 months ago, there was a room full of folks just saying, like, yeah, man, my business is down 50, 60, 70%. There's a WhatsApp group now called EO Grid. It had 600, so a quarter of the 2,000 business owners all joined this group saying, my business is trying to survive. It's this weird disconnect where, like, that's a large anecdotal swath, but I don't have any data, I don't have anything that talks about that impact right now and how severe that is for some folks. Curious if you see that reflected anywhere else.
And could y'all repeat the question for the recording, please?
Is that for you? Or is it?
Oh, you want me to go first? So just to repeat the question, somebody noted that there's some anecdotal evidence that there are a broad swath of businesses, either on the East Coast, probably throughout the country, that are challenged. So even though Lauren or ourselves would put up charts showing how strong the U.S. or solid the U.S. economy is, there certainly are areas that are facing some issues. I think that's probably always the case. In fact, I'm sure that's always the case. Not every industry, not every business owner has a thriving business, even in the good times. You might be over-levered, and so you're choking on your interest expense. You might have the wrong product line. You've got too many SKUs. So there's a number of reasons why you probably in all times have a broad swath of the economy that is not doing as well as the average, and certainly not doing as well as the folks who are always telling you how great their business is going. And for the investing markets, that's also always the same, right? Not every asset class is in a bull market. U.S. stocks are, but if you were to look at the developed international markets or the emerging markets for equities, they're not doing anywhere close over the last 15 years, as well as the U.S. stock market, or even just the large cap area of the U.S. stock market. So there's that, and that just underscores the point of being diversified from an investment standpoint, from a SKUs standpoint, from an industry standpoint. So I guess that would be my answer to that question.
I think, it's hard to read the label from inside the bottle, right? That could just be it could have the wrong state. Yeah, we talk about being over-levered, bad team, bad leadership. I've seen it. I've been around EO for a long time. I've seen it in this organization. I've seen good business. I've seen businesses well run, businesses not well run. So it's not like collectively we all sort of move at the same pace. In fact, I even wrote down a comment that Lauren made. Not every business moves through the cycle at the same rate. Well, I think that's completely evidence that execution matters, and the business model. I'll say it for the fourth time. Business model matters, and find me a business. Find me that owner. If I could sit down with that owner for 15 minutes, I could probably help him or her diagnose the specific problems he was having, and to get into the psychology of it, by complaining about the silent pandemic, he's probably looking at the wrong place to try to find a fix.
So quiet, somebody.
much to take in, and such incredible advice from guys that have their hands on the pulse. And we really appreciate it. Matt, especially just flying in for this. We really appreciate it. Adam is available and Adam and Jim in your forums. If you want to find out more about this and want to keep your finger on the pulse, these guys are available. So thank you again for doing this. We really appreciate it. Everybody have a great day and enjoy your weekend.